You read the headline, silver hits all-time highs. You heard analysts blaming speculation. You watched experts talk about temporary volatility. The real story was never there. The real story lives in the numbers no one wanted to see and in the valves that quietly shut off on New Year's Eve. January 2026 is not just another month. It is the month the global silver supply system suffered a structural breakdown. Not a correction, not an adjustment, a physical default. The endgame began precisely at 0001 on January the 1st, when China's new export rules for silver quietly snapped into place. To understand what happened, you cannot use headlines. You need to use physics, market physics. China controls between 60% and 70% of the world's refined silver supply. That is not a market share. It is a choke point valve on the flow of the most conductive industrial metal on Earth. From January 1st, 2026 onward, only Chinese refiners above a hard threshold of production volume and credit capacity can legally ship silver abroad. Hundreds of mid-tier and smaller exporters were cut out overnight, not restricted, not discouraged, ejected from the global game. This is not trade policy. This is weaponized logistics. It is China applying its rare earths playbook to a metal even more critical than most investors realize. While everyone obsessed over chips and semiconductors, Beijing quietly wrapped its hand around the final node of the energy transition supply chain. And the market was already broken before that move. For 5 consecutive years, global silver demand has been running ahead of total supply. In 2025, the deficit reached 230 million ounces. UBS recently increased its 2026 silver supply deficit forecast to 300 million ounces. This is not a temporary imbalance. It is structural hemorrhage. Now China has shut the last release valve. The result is not simply a higher price, it is a reset, a forced repricing of every contract built on the assumption that physical metal would always be there when paper asked for it. Behind the noise, global inventories were being drained. Registered COMEX stocks dropped 70% since 2020. LBMA vaults in London lost 40% of their holdings. Shanghai hit decade lows. Manufacturers depleted safety stocks to maintain production schedules, increasing vulnerability to supply chain disruptions. For the first time in modern history, the 3 largest transparent silver inventories, Shanghai, COMEX, and LBMA, are all draining simultaneously at record speed. Nearly 1 billion ounces of refined silver have vanished from visible stocks since 2021. Industrial stockpiles are gone. There's no quick fix. There are no instant new mines. There's no spare metal. Silver supply is structurally trapped because roughly 70% to 80% of global production comes as a byproduct of copper, zinc, and lead mining. That means higher silver prices alone do not create more silver. New mining projects take 8 to 12 years to reach operation. Ore grades continue declining. The supply response is glacial, while demand is an avalanche. After an estimated 2% growth in 2025, global silver production is expected to decline at a compound annual rate of negative 0.9% through 2030. Mexico, the world's largest silver producer, is expected to see production fall due to mine closures including San Julian approaching end of life in 2027 and planned gradual closure of Mercedes, Bolañitos, San Rafael, Dolores, and San Dimas. Peru will decline due to closure of Cerro de Pasco and Andaychagua. Bolivia will lose San Bartolome and Caballo Blanco. China's silver production will be constrained by lack of new capacity additions and planned mine closures. Russia, India, and Kazakhstan are all closing major operations. By 2030, global silver production is projected to drop to 901 million ounces. This is not a forecast. This is engineering reality. And the demand is not speculative. It is physical. It is industrial. It is irreversible. Every solar panel uses 20 grams of silver for its unmatched conductivity. Every electric vehicle consumes up to 2 ounces in sensors, wiring, and power modules. AI data centers, 5G infrastructure, electronics manufacturing, all pulling from the same shrinking pool. Silver demand for photovoltaic applications jumped over 25% in 2024, hitting 230 million ounces, and may exceed 300 million ounces annually by 2030. New TOPCon solar technologies alone require up to 50% more silver than traditional panels. The International Energy Agency estimates that by 2030, solar and EV sectors alone will consume half of global silver production. And unlike copper or aluminum, silver has no viable substitute. Its unique conductivity and reflectivity make it irreplaceable in high-performance technologies. This means industrial demand is effectively inelastic. It does not shrink even when prices spike. As supply tightens, factories will keep buying at any price to keep production lines running. Elon Musk does not post about commodities, but on December 29, 2025, he wrote, "This is not good about the silver market," because he knows what this means for Tesla, for his gigafactories, for the global electrification his company symbolizes. Apple, Samsung, and other major manufacturers are now abandoning the exchange entirely and buying direct from miners at $85, $90. While everyone slept, the market structure was collapsing. On October 10th, 2025, silver's annualized backwardation rate hit 20%. That means spot silver was trading at a massive premium over futures, a brutal inversion of normal market structure. Backwardation is the purest signal of extreme physical scarcity. It is the market screaming that physical metal is now worth more than paper promises for future delivery. It is physical reality taking control over financial abstraction. In the same session, the 1-month silver lease rate in London spiked to 39%. For a perspective, that is roughly 7 times higher than typical levels. Lease rates indicate the cost of borrowing physical silver and serve as a measure of demand. Their elevation is attributed to low liquidity in London, exacerbated by a recent surge in silver-backed exchange-traded fund demand. The LBMA's free float, the physical silver immediately available to settle London's vast unallocated accounts, collapsed to just 155 million ounces in October. That is only 6 weeks of global consumption. As the epicenter of global silver trading, this is a warning signal that cannot be ignored. Bid-ask spreads in the London spot market exploded from pennies to $6 to $8 per ounce overnight. This is not volatility, it is liquidity breakdown. It is the physical market disconnecting from the paper market. Physical silver deliveries face extended wait times from major dealers, with premium products often on allocation. Retail premiums on silver products have widened significantly above spot prices, particularly for smaller denomination products. Silver ETF holdings have remained relatively flat despite price increases, suggesting limited physical availability for creation units. In Shanghai, between October 1st and November 21st, 2025, the vaults lost 670,277 kilogars in 51 days. That is a 56% drop in 7 weeks. China consumes more than half of global industrial silver, primarily for solar panel manufacturing, EV production, and electronics. The structural demand, combined with Chinese vault withdrawals, created backwardation in some contracts, a rare sign of acute and immediate supply stress. The market was in deep backwardation before China even activated its export restrictions. The system was already failing. Now it has fractured completely. The distinction between allocated and unallocated precious metals accounts has become critical. Allocated accounts involve specific bars assigned to account holders with segregated storage, while unallocated accounts represent general entitlements to metal without specific bars assigned. Unallocated accounts create unsecured creditor relationships during supply shortages. Account holders may face difficulty obtaining physical delivery when institutions lack adequate backing for their paper positions. The suspension of investment subscriptions by major financial institutions signals that traditional London-centered silver supply chains can no longer reliably service global investment demand. Daily trading volume on major exchanges can exceed physical delivery capacity by 200 times or more. Only a small percentage, typically less than 1%, of futures contracts result in physical delivery. This leverage creates vulnerability during periods of physical supply constraints. Price discovery becomes distorted when paper markets and physical markets diverge. This disconnect becomes particularly important during supply crunches, when more contract holders may seek physical delivery, potentially exposing the limitations of available physical inventory. The unallocated market is the product of bank credit expansion, not real metal. Outstanding OTC contracts in precious metals represent volumes that dwarf the physical stocks backing them. And then, in a move that will change the silver market forever, JP Morgan executed the largest position reversal in commodity history. Between June and October 2025, the bank reportedly sold its entire 200 million ounce short position in paper contracts and went long, not in paper, in physical metal. JP Morgan now holds over 750 million ounces of physical silver, the world's largest stockpile. That equals nearly an entire year of global mining production. This is not a hedge, not speculation, it is strategic positioning. JP Morgan, historically accused of suppressing silver prices through aggressive COMEX short selling, has now removed the largest long-standing downward price pressure from the market. The acquisition of 750 million ounces of physical silver exacerbates existing supply deficits and paves the way for a structural revaluation of silver's value. This is fundamentally different from the Hunt brothers' 1980 attempt to corner silver. Back then, reliance on paper contracts led to intervention and collapse. JP Morgan's approach of holding physical metal reduces the risk of regulatory disruption. The mechanics of power have shifted. The largest price suppressor became the largest physical accumulator, and it did so in the 6 months before China activated its export restrictions. The convergence is not coincidence. It is intelligence. It is what happens when those closest to the plumbing front-run a structural break. Behind the scenes, major mints ran out of physical silver. The US Mint announced coin shortages. Meanwhile, COMEX inventories approached record highs at 526.1 million troy ounces. But this metal is not available. There's a real shortage of silver in London, but there are 500 million ounces sitting in COMEX. So much metal flowed to the US that we now have nearly 4 years of domestic demand stored, but it cannot be mobilized quickly enough to close London's liquidity gap. The fractional delivery system underpinning London's unallocated market is breaking. TD Securities estimated in October that there are likely less than 4 months remaining until the LBMA's entire free float stock is exhausted. This would lead to elevated price gaps and restricted liquidity, and each drain from current levels should be favorable to silver prices. We're not talking about a short-term squeeze. We're talking about the terminal collapse of a 50-year market system. The math points to a potential 2026 delivery crisis. Years of massive supply deficits, record industrial demand from solar, EVs, AI, and electronics, and shrinking deliverable stockpiles are pushing the futures market toward a default-style event. Backwardation, rising physical premiums, and direct mine supply deals signal extreme stress. Force majeure cash settlement could create a two-tier market. And now China has activated its restrictions. January 2026, day zero. The flow that kept the global market breathing was cut at the root. Analysts are still talking about rate cut optimism and geopolitical tensions. They have not understood. This is not about interest rates. This is not about abstract geopolitical risk. This is about physics, about atoms, about the real infrastructure of the global energy transition colliding with the reality that there is not enough metal. Silver rose 182% in 2025, driven by supply constraints and industrial demand. But that was before day zero, before the valve closed, before the world woke up to the fact that paper contracts promising future silver delivery may not have physical metal behind them. The COMEX has not even officially opened yet for 2026, and we already have the first casualty. A major private transaction between an industrial buyer and a wholesale supplier just failed. The buyer had cash. The supplier looked at their empty vault and said one word: no. This is what a default looks like, and the public market does not even know it happened yet. The contract defaulted, not because of speculation, not because of human error, but because the underlying asset was physically missing. This failure is a signal to the market. The system has entered a phase where physical scarcity is dictating outcomes, and paper prices no longer provide an accurate reflection. The $12 premium explosion proves the real silver price is $82.60, not the $70.60 ghost number frozen on your screen. The gap between paper price and physical price proves the spot price is now a fiction. The premium is the new floor. The two-price world is now official. Banks use force majeure clauses to cash you out at artificial prices, while keeping your upside. Force majeure in commodities refers to official exchange rules regarding delivery failures and cash settlement during market disruption events. When physical supply cannot meet contracted delivery, the exchange or counterparty can invoke these clauses to settle in cash rather than metal. This is the soft default mechanism. You hold a contract that promises silver. The delivery date arrives, the vault is empty. The bank says market disruption and hands you cash at the spot price, the paper price, while the physical metal you were promised is now trading $12 higher in the real world. You are forced to accept the ghost price while others pay the real price. The industrial exodus is now underway. Apple, Samsung, and Tesla are abandoning the exchange entirely and buying direct from miners at $85, $90. This renders public inventory data useless. The visible market is no longer where the real transactions happen. The real market has gone dark, moved off exchange into private contracts, negotiated mine to factory with no public price discovery. Each failed delivery reinforces scarcity, driving premiums higher and signaling to the market that physical supply cannot meet demand. By mid-January, it is plausible that 2 or 3 more delivery failures will occur. The probability of cascading defaults is high. Each failure will widen the gap between paper and physical. Each failure will accelerate the exodus from exchange-traded contracts. You are witnessing the final separation between real assets and financial promises, between the physical and the digital, between what can be touched and weighed versus what can be typed on a screen. The paper price system may not survive a world running out of real silver. The nickel market halt of 2022 provides the precedent. When nickel prices exploded due to a short squeeze, the London Metal Exchange canceled trades and forced cash settlement. Participants who were positioned correctly, who were long physical nickel, had their winning positions erased by regulatory intervention. The exchange simply rewrote the rules mid-game to protect the losing side. This is the template. When the COMEX or LBMA face a delivery crisis they cannot solve, they will invoke force majeure, halt trading, cancel contracts, or force cash settlement at prices that do not reflect physical reality. Your paper claim to silver will become a cash settlement at a manipulated price, while those holding physical metal capture the true value. Silver ETF cash settlement clauses exist in the prospectus of major funds like iShares SLV. Legal documentation shows conditions under which silver ETFs can settle in cash rather than metal. When you buy an ETF, you're not buying silver. You're buying a claim on silver that can be converted to cash at the fund's discretion under stress conditions. Capital has no feelings. It has destinations. And capital's destination now is a desperate race to physical assets before the last vault is emptied, before the last exporter is blocked, before the $2 trillion derivatives market realizes it is sitting on nothing. The Sunday night trap is real. When the Globex opens after a weekend of negative news, volatility spikes and stop losses are hunted. Banks engineer downward price moves to shake out weak hands before the next leg up. If you panic, sell your position during manufactured volatility, you donate your upside to the institution's exit strategy. They accumulate your metal at suppressed prices and position for the inevitable spike. The 20 to 30 minutes you spent here were not about silver. They were about pattern recognition, about understanding that when capital flows converge with infrastructure bottlenecks and geopolitical leverage, the official narrative becomes irrelevant. China closed the valve. JP Morgan accumulated the stock. Global vaults are empty. Industrial demand is inelastic. Supply takes a decade to respond and is projected to decline through 2030. The paper market is in backwardation. Major manufacturers are buying direct from mines at premiums. Mints are out of stock. London's unallocated system is breaking. These are not disconnected data points. It is a sequence. It is mechanics. It is the sound of a 50-year system breaking in real time. And the rest of the world has not noticed yet because it is watching headlines instead of flows. Day zero is not when the crisis begins. It is when the crisis becomes undeniable. It is when price stops being discovered by algorithms and traders and starts being determined by desperate factories willing to pay anything to keep production running. It is when governments realize their renewable energy targets are built on a commodity that does not exist in sufficient quantity. It is when pension funds discover their silver ETFs have claims on the same empty vaults. The story was not in the headline. The story was in the silence of Shanghai's vaults draining, in the mechanics of London's lease rates exploding, behind the scenes of China's export licenses being issued only to state giants. In the first private delivery failure of 2026 that happened before the exchange even opened, you saw the headline. But now you see the structure. The lever has been pulled, the valve has been closed, the system has broken. And those who did not adapt, who still believe papers equal atoms, will be left holding promises while others hold metal. The first promise has been broken. The $12 premium is the new floor. Day zero has arrived. The only question remaining is, which side of the separation are you on?